Hey friends, welcome to the Stratonia podcast. This show is all about strategy, entrepreneurship, and smart business thinking, especially for African founders and professionals. I share lessons, tips, and insights from years of building businesses, and if you want to grow smarter and run better businesses, this is your podcast. Today we will be diving into our blog post, Tax Made Simple, a Ghanaian SME's Guide to TIN-N, VAT, and Income Tax. Look, let's be real. For many of us running small and medium-sized businesses here in Ghana, the topic of tax can feel, well, let's just say it's not usually at the top of our favorite things to think about. It often brings to mind, complicated rules and the worry of potential penalties, which can add a lot of unnecessary pressure.
That's a sentiment we hear often, definitely. The very idea of tax can feel like wading through a dense forest of regulations and paperwork. Many SME owners have told us they find the system confusing and, frankly, a real drain on their time and resources.
Exactly. But here's what we really want to explore today. What if we shifted how we see tax? Instead of viewing it as just another burden, what if we understood it as like a fundamental part of building a strong and sustainable business? Right up there with understanding your customers or managing your stock.
Precisely. Think of it less as an obstacle to overcome and more as an essential component of the business environment. Just as you need to know your market or how to deliver good service, a solid understanding of the basic tax system is just vital for long-term growth and stability.
So that's the mission we're on in this deep dive. We're going to break down the essential elements of Ghana's tax system for SMEs specifically, the tax identification number, value-added tax, and income tax. Our aim isn't just to make them understandable, but, to provide you with actionable insights you can actually use right away.
We want to clarify the what's and, crucially, the why behind each of these elements and give you clear, practical steps to ensure you're compliant. It's about moving from that feeling of uncertainty to one of, well, confidence and control.
And the advantages go way beyond simply avoiding penalties, right? Getting a good grasp of the tax system can actually lower your stress, help you make smarter financial decisions, and even boost your business's reputation with banks and potential investors. Plus, having a TIN, for example, can open doors to more formal operations, like easily setting up a business bank account.
That's a critical point. While compliance is, of course, a legal necessity, the benefits extend significantly further. Being tax-aware contributes directly to the overall health and resilience of your business.
All right, so let's get down to the bedrock of it all, your tax identification number, or TIN. What exactly is this, and why is it so absolutely essential for a business? I've heard some people say it's just another piece of bureaucracy. Is there a real tangible benefit for a small business owner in getting one beyond just avoiding trouble?
That's a fair question. And while it might seem like just another form to fill out, your TIN is fundamentally your business's unique identity within the tax system. It's an 11-digit number issued by the Ghana Revenue Authority, or GRA. You can think of it as your tax fingerprint, sort of specific to you or your business. The tangible benefit, well, it unlocks your ability to operate formally and access various crucial business functions.
Okay, tax fingerprint. I like that. It makes it sound a bit less abstract. So beyond just being a number, why is having this so crucial for an SME in Ghana?
It's essential for several key reasons that directly impact your business's ability to function and, well, grow. Firstly, it's non-negotiable for filing any tax returns, whether it's VAT or income tax. You just can't do it without one. Secondly, it's often a prerequisite for formally registering your business with the Registrar General's Department. And finally, it's required for a lot of official transactions that can help your business grow, like opening a business bank account, applying for loans, or clearing goods if you're involved in any import-export activities. Without a TIN, you're essentially locked out of many aspects of the formal economy.
Right. So it really is the key to participating fully in the formal business landscape. What if someone listening realizes they don't have a TIN yet? What are the immediate steps they need to take?
The good news is that getting registered for a TIN is generally a pretty straightforward process. If you don't have one, the first thing you should do is visit the GRA website. That's www.grla.gov.gh. Or just, pop into your nearest GRA office to start the process.
Okay. And what kind of information or documents will they need to have ready when they go?
For individuals, you'll typically need a valid form of identification, and the Ghana card is the most common and easiest to use. For businesses, you'll also need your business registration certificate. On the GRA website, you can usually find and download the relevant forms, Form TIN-1 for individuals and Form TIN-2 for businesses. You'll complete the form and submit it along with your ID.
And then what happens? Is it a long, drawn-out process to actually receive the TIN?
In most cases, the GRA is quite efficient, actually. They will register you and send your TIN via SMS or email, usually within, say, 1 to 2 working days. So it's relatively quick turnaround. And if you already have a TIN, the most important thing is just keep it safe and make sure it's correctly listed on all your invoices and official business documents. Think of it like your business's national ID number for tax stuff.
That makes sense. So, just to recap the how-tos first, head to the GRA website or your local office. Second, look for Form TIN-1 if you're an individual, or Form TIN-2 if you have a registered business. Third, fill it out and submit it with your Ghana card or business registration documents. And fourth, keep an eye on your phone and email for that 11-digit number. We even have a little checklist here. Ghana card or valid ID, business registration if it applies to you, and the completed form. Pretty simple.
Exactly. And to make this real, let's consider Akua, who runs a thriving Hilarelli business. She had an opportunity to start supplying several local offices with snacks and also wanted to become a registered mobile money agent. Both of these required her to have a TIN. So she visited the GRA office at La Paz with her Ghana card, filled out a short form, and honestly, by the next morning, she received her TIN via SMS. She used it immediately to finalize her mobile money registration and open a dedicated business bank account, which really streamlined her operations. It truly was that initial key that unlocked significant growth for her.
Akua's story really brings home how that seemingly small first step can open up so many doors for expansion and, credibility. So the clear message here is, getting your TIN is absolutely the first and non-negotiable step for any SME owner looking to operate within the formal tax system.
No doubt about it. It's the very foundation on which all other tax obligations and, well, benefits are built.
All right, so we've laid that crucial foundation with the TIN. Now let's move on to the next vital component, understanding value-added tax, or VAT. In simple terms, what exactly is VAT and how does it work for a business?
Okay, so at its core, VAT is a tax on the consumption of most goods and services in Ghana. What's really important for business owners to grasp is that generally they act as intermediaries, kind of collecting this tax on behalf of the GRA. So when you sell a product or service that's subject to VAT, you add the VAT amount to the selling price, and then you are responsible for remitting that collected tax to the government. Think of it as being a collection agent for the GRA.
So it's like the business is facilitating the tax collection from the end customer. Got it. Now, who exactly needs to register for VAT? Is it every single business out there?
Not every business, no. There's usually a threshold based on your annual taxable sales. If your sales exceed a certain amount set by the GRA, then you are required to register for VAT. However, and this is important, this threshold can change, so it's crucial to stay updated by regularly checking the GRA website. Also, even if your sales are below the mandatory threshold, you might be able to register for VAT voluntarily, and in some cases, it might even be a requirement for certain types of business activities or, say, to secure contracts with larger organizations.
Okay, so the first key is knowing that threshold and keeping an eye on any changes. Now, if a business does need to register for VAT, what's the typical process they need to follow?
Right. The process involves a few key steps. First, you'll want to confirm your annual turnover against the current VAT threshold, which, as we mentioned, you can find on the GRA website. If you meet or exceed it, or if you need to register voluntarily, you'll then need to visit your nearest GRA office or a dedicated VA office. There, you'll complete the V8 registration form, providing your TIN, business registration certificate, and details about your business location.
And I understand that the GRA might also want to conduct a physical check of the business premises, right? Is that common?
Yes, that's correct. The GRA will typically conduct an inspection of your business premises. It's mainly to verify your operations and ensure you have the capacity to handle V8 obligations properly. Once everything is approved, you'll be issued a VAT certificate, which is your proof of registration.
Okay, so a few more items on our checklist for VAT deregistration. Your all-important TIN, your business registration documents, the VAT registration form itself. And it also mentions needing an invoice book. Is that specifically for issuing those VAT-compliant invoices?
Exactly. If you are V8 registered, you are required to issue proper V8 invoices for all your VATable sales. These invoices need to include specific information as mandated by the GRA, like your V8 registration number and the breakdown of the V8 charged. To illustrate how V8 registration can open doors, think about Mensa, who runs a successful provision store in Kumasi. He had an opportunity to become a key supplier for a large supermarket chain. But one of their requirements was that all suppliers had to be V8 registered, mainly to facilitate their own input tax claims. Mensa wasn't registered, so he went through the process we just described, visited the GRA, provided his documents, underwent the inspection, and received his V8 certificate. This registration enabled him to secure a significant and long-term business relationship that really propelled his growth.
That's a powerful example. It shows how V8 registration, while it might seem like an added layer of complexity, can actually be a strategic move for business expansion. Now let's try to break down the core mechanism of how V8 actually works day to day. We've talked about collecting it from customers, but what happens after that collection?
It essentially comes down to two concepts: output VAT and input VAT. When you make a sale of goods or services that are subject to V8, you add the standard VAT rate, which is currently 15%, and includes components like NHIL and Get Fund Levy to your selling price. This collected amount is your output VAT. Now, when you buy goods or services for your own business from other VAT-registered suppliers, you also pay V8 on those purchases. That's your input V8.
Okay, so output is the VA I charge my customers, and input is the V8 I pay to my suppliers. What's the relationship between these two? How does it work out?
Periodically, usually every month, you calculate the difference between your total output V8, the V you collected, and your total input V8, the V you paid on eligible business purchases. You then pay this net amount to the GRA. If, in a particular period, your input VA happens to be higher than your output VA, maybe you made significant upfront investments or something, you might even be eligible for a refund or receive a credit that can offset future V8 liabilities.
That's good to know. It's not always just about paying money out. Can you give us a quick real-world example to make this even more tangible? Like with a shop.
Absolutely. Imagine Amma's boutique sells a locally made dress for GHS 200 and V8 applies. She would collect the VAT amount, which is 15% of GHS 200, so GHS 30 from her customer. The total price becomes GHS 230. Now, let's say Amma purchased the high-quality fabric for that dress from a VAT-registered textile wholesaler and paid maybe GHS 15 in VA on that purchase. She can potentially deduct that GHS 15 input VA when she calculates how much VA she owes the GRA from the sale of the dress. In this simplified example, she would remit GHS 15. That's the GHS 30 output VA minus the GHS 15 input VA.
Got it. So meticulous record keeping of both sales and V-eligible purchases is absolutely key to correctly calculating and potentially reducing your VA liability. It sounds crucial. What are some concrete, actionable habits that businesses can develop right away to stay on top of their V8 obligations and avoid issues?
Definitely. First, as we've emphasized, know the current VAT threshold. Make it a habit to periodically check the GRA website for any updates. Don't get caught out. Second, maintain incredibly clear and organized records of all your sales. Make sure you clearly show the VAT charged separately on each invoice. Crucially, also keep all original VAT invoices for any business purchases you make from other VAT-registered entities. These are your proof for claiming input VAT. If you are VAT registered, ensure that your own invoices comply with all the GRA's requirements, format information, all that. And finally, it's vital to file your VAT returns and pay any amount due on time. This is usually done electronically through the GRA's ITAP-PIS portal by the end of the month following the VAT period. Don't miss those deadlines.
Right. So in practical day-to-day operations, it's about consistently adding the VAT to your prices, diligently keeping those purchase receipts from VAT-registered suppliers, totaling up your output and input VAT each month, and then ensuring timely filing and payment of the difference. And you mentioned ITAP-PIS. For someone who might be new to this, what exactly is ITAP-PIS and how can they get started with it? It sounds a bit technical.
Yeah, ITAP-PIS is the Ghana Revenue Authority's online platform. It's designed to streamline tax processes, including VAT filing and payments. It might seem a bit intimidating initially, I get that, but it's a powerful tool that can save you a lot of time and effort once you get the hang of it. To get started, you'll typically need to register for an account on the ITAP-PIS portal, which you can access through the GRA website. The GRA also provides support and resources guides, sometimes even workshops. If you find the initial registration or navigation confusing, honestly, don't hesitate to reach out to the GRA directly or visit one of their offices for assistance. Many business owners find it helpful to go to a place with reliable internet access, like a local internet cafe, just to register and get familiar with the platform.
Oh, a great example here is someone leveraging ITAP-PIS in their daily business, right? Amma with the Kenki.
Yes. Think about Amma, who runs that popular Kenki and stew joint in Jamestown. When she started landing larger catering contracts for office lunches, she became V8 registered. She made a conscious effort to buy her maize, fish, and other supplies from V8 registered wholesalers and diligently kept all their V8 invoices organized in a simple file. At the end of each month, she would visit a local cafe with reliable Wi-Fi, log into iTap ACES on her phone, carefully enter her total output V8 from her catering sales and her total input VA from her supplier invoices, and then pay any net VAT due directly through the platform. This allowed her to manage her VAT obligations efficiently, even without a dedicated office setup or, a full-time accountant in the early stages.
That's a fantastic example of how technology can simplify compliance, even for smaller scale operations. It's really accessible. Okay, so we've now covered the foundational TIN and the consumption tax, VAT. Let's move on to the tax that's directly linked to the profitability of your business, income tax. This feels like it directly reflects the success of all our hard work, doesn't it?
Absolutely. Income tax is essentially a levy on the profits that your business generates. However, the specific way it's applied depends significantly on the legal structure of your business. The two primary forms relevant to most SMEs are corporate income tax, or CIT, and personal income tax, or PIT.
Okay, can you clearly explain the key differences between CIT and PIT and which types of businesses they apply to? That distinction seems important.
Certainly. Corporate income tax, or CIT, is specifically for businesses registered as limited liability companies. Think LTD. It's calculated as a fixed percentage of the company's taxable profit. That's the profit that remains after you've deducted all the allowable business expenses as defined by the GRA. Personal income tax, or PIT, on the other hand, applies to businesses that are not legally separate from their owners, like sole proprietorships and partnerships, your typical enterprises. In these cases, the business's profit is treated as part of the owner's personal income and is taxed according to a progressive tax band system. This means that different portions of your total income are taxed at increasing rates, so higher income levels face higher tax percentages.
Got it. So if you've registered your business as a limited liability company, you'll be dealing with CIT. Whereas if you're operating as an individual under your own name, your business profits will fall under PIT. What are the most important concepts related to income tax that every business owner should have a solid understanding of? Key terms, maybe.
Okay, several fundamental concepts. First is taxable profit. It's crucial to understand that this isn't simply your total revenue, not the top line. It's your total income minus the specific business expenses that the GRA permits as deductions for tax purposes. These could include things like rent for your business premises, salaries you pay to employees, utility bills directly related to your business operations, and the cost of the goods you sell. However, it's important to be aware that not every single expense you incur might be deductible. You need to check what's allowable. Then there are the tax rates. For CIT, there's a standard corporate tax rate in Ghana. You should always confirm the current rate with the GRA. For PIT, as we mentioned, it's a system of graduated rates, meaning the percentage of tax you pay increases as your taxable income goes up. Lower income bands pay less, higher bands pay more. Finally, there's the aspect of filing and payment. Businesses are generally required to make estimated tax payments on a quarterly basis, and then file a final annual income tax return after the end of their financial year, usually by April.
Can you walk us through a quick example to really solidify the difference between how CIT and PIT would work in a practical scenario, maybe with Kofi?
Sure. Let's say Kofi runs a creative agency specializing in graphic design. If his business is registered as Kofi Designs Limited, and in a particular year the company generates a revenue of GHS 80,000 but incurs GHS 50,000 in allowable business expenses, his company's taxable profit would be GHS 30,000. Kofi Designs Limited would then be subject to CIT on this GHS 30,000 profit at the prevailing corporate tax rate. Now, if Kofi operated the exact same graphic design business as a sole proprietor under his own name, maybe Kofi Designs Enterprise, and he made the same GHS 30,000 profit after deducting his allowable expenses, this GHS 30,000 would be considered part of Kofi's personal income. It would then be taxed according to the applicable PIT rates based on his total income from all sources for that year.
That example clearly illustrates how the business structure dictates the type of income tax that applies. It's a key decision point for businesses. So what are the basic steps that a business owner needs to take to register for and then pay their income tax, whether it falls under PIT or CIT? What's the process?
Okay, the first step is definitely to correctly determine which tax category your business falls under: PIT for sole proprietors partnerships, CIT for limited companies. Get that right first. Regardless of the category, maintaining meticulous monthly records of all your business income and all your allowable business expenses is absolutely crucial. Can't skip this. Based on your estimated profit for the year, you'll typically need to calculate and submit quarterly estimated tax payments to the GRA throughout the financial year. So paying as you go, essentially. Finally, you will be required to file your final income tax return by the deadline, which is usually around April of the following year, to reconcile your estimated payments with your actual profit and tax liability for the whole year.
So consistent and detailed record keeping continues to be a central theme across all aspects of taxation. It just keeps coming up. What specific types of documents and information should businesses be keeping on hand for income tax purposes? Like, what should be in that file?
You'll need a comprehensive log of all your sales and all your business-related expenses, and importantly, the supporting documentation, invoices, receipts, bank statements. You'll also need your business's TIN, readily available, of course. And it's really wise to keep copies of all tax payment receipts that the GRA issues when you make your quarterly or annual payments. Proof of payment is key.
We have an example here of Sarah, who runs a small but growing business selling natural skincare products from her home. How does personal income tax typically apply to her situation? She's a sole trader.
Exactly. Sarah diligently tracks her monthly sales from her skincare products and also keeps a record of all her business-related expenses, cost of raw materials, packaging, any delivery charges, things like that. She visited the GRA office in her district, where a tax officer explained to her how the personal income tax system works and helped her understand how to estimate her annual profit based on her income and expenses. She registered as a sole proprietor under PIT and agreed on a schedule for making small estimated tax payments on a quarterly basis. With some guidance from a family member who works in accounting, she was actually able to file her first income tax return. It shows that even for home-based businesses, understanding and complying with PIT is definitely achievable with a bit of effort and the right info.
So just like we saw with VAT, developing some key habits is crucial for staying compliant with income tax as well, right? What should people focus on?
Absolutely. Habits make it manageable. First, meticulous record keeping. Every single source of income, every legitimate business expense with all the supporting documents. Absolutely vital. Second, take the time to understand which expenses the GRA allows as deductions for your specific type of business. This can significantly impact your taxable profit. Don't guess, find out. Third, make a note of and strictly adhere to all filing deadlines, both those quarterly estimated payments and the final annual return. Put them in your calendar. Fourth, consider making those provisional payments throughout the year. It really helps avoid a large and potentially stressful tax bill at the end of the financial year. Spreads the load. And fifth, as a general rule of thumb, make it a regular practice to set aside a specific percentage of your income, maybe 10%, 15%, specifically for your future tax obligations. Put it in a separate pot.
These are all incredibly practical steps that can really help demystify income tax and make it much more manageable for SME owners. Feels less scary broken down like that. Now, we've covered the three big areas: TIN, VAT, and income tax. What are some overarching key habits that SMEs in Ghana can cultivate to ensure they stay compliant across the board and significantly reduce the anxiety often associated with tax matters? The big picture habits.
Yeah, building a set of simple, consistent habits is truly the key to transforming how you approach the tax system, making it much less daunting. The first and most crucial habit, which we've touched on repeatedly, is impeccable record keeping. It's the bedrock for everything: VAT, income tax, understanding your financial health. Make it non-negotiable, daily or weekly. Second, maintain a strict separation between your business and personal finances. Use a dedicated business bank account. It makes tracking income and expenses far simpler and clearer. Avoid mixing funds. Third, make it a point to stay informed. The GRA website is an invaluable resource for the latest updates on tax rates, thresholds, deadlines. Tax laws and regulations can change, so keep up. Fourth, prioritize filing your returns and making payments on time. Mark those crucial deadlines in your business calendar. Use the GRA's ITAP-PS portal for electronic filing and payments. It really streamlines the whole process. And finally, don't hesitate to seek professional guidance when you need it. Engaging a qualified accountant or tax advisor might seem like an added expense, but honestly, the expertise they provide can often save you significant money and stress in the long run by ensuring you're compliant, claiming all eligible deductions, and avoiding costly penalties. It can be an investment.
Those are some truly excellent and actionable habits that can make a real difference. And we have a specific actionable tool here focusing on building daily tax discipline. Can you tell us more about how our listeners can practically implement this, make it routine?
Yeah, this is all about integrating tax-related tasks into your regular business routine so they become second nature rather than something you dread and put off. This could involve simple actions like keeping a dedicated notebook or using a notes app on your phone to record every single sale and every business-related expense as they happen. Don't wait. Get into the habit of saving those mobile money transaction messages. Keep all your paper receipts organized in a designated folder or file. Don't let them pile up. If you're not yet comfortable with online filing, consider making a monthly visit to a GRA kiosk at your local market or business center. Ask for clarification or assistance with basic record keeping. They're there to help. And importantly, try to make it a habit to regularly set aside a portion of your business income, perhaps a fixed percentage like 10 to 15% in a separate account, or even a traditional SUSU contribution, specifically earmarked for future tax payments. This small act of financial discipline can really ease the burden when tax deadlines approach. You'll thank yourself later.
So it's about weaving these small, manageable actions into your day-to-day or week-to-week workflow. Not a huge overhaul, just small steps. We have a practical checklist here for building that daily discipline. Aim to record all sales and expenses at least weekly. Get in the habit of taking screenshots of digital receipts or keeping paper files tidy. And consider making that monthly visit to the GRA help desk if online filing still feels challenging. And we have the example of Kojo, who sells delicious fried yam by the roadside. He diligently writes down his daily sales in a small notebook, keeps all his receipts in a plastic wallet, gets his niece, who's good with computers, to help him total everything in a simple Excel sheet at the end of each month. And he makes a point of visiting the GRA kiosk quarterly to ensure he's on track with his income tax obligations. It really underscores that this kind of consistent discipline can be built into any type of business, no matter how small.
Exactly. It's about finding a system that fits your specific business and, crucially, sticking with it consistently. Consistency is key.
And finally, what are your top final tax habits that you believe are essential for long-term success and sustainability for SMEs in Ghana? Just to wrap it up.
Okay, to summarize for lasting success, always maintain a clear separation between your personal and business finances. Separate accounts, separate records. Make absolutely sure you keep backup copies, both physical and digital if possible, of all the tax forms and supporting documents you submit to the GRA. Don't rely on just one copy. Make it a routine to regularly review any notices or communications you receive from the GRA. Don't ignore them. Stay proactive in keeping up with any changes in tax thresholds, rates, or regulations. As we said, things change. And as we've stressed before, never hesitate to seek professional advice from a certified tax advisor if you ever find yourself feeling confused, overwhelmed, or just uncertain about any aspect of your tax obligations. Get help when you need it.
So the overarching message is clear. While Ghana's tax system may initially seem intricate, maybe a bit complex, gaining a solid understanding of its fundamental building blocks, your KIN, the basics of VAT, and the core principles of income tax truly empowers you as a business owner. It shifts your perspective from one of maybe apprehension or fear to one of confidence in managing your responsibilities and planning for your business's future.
Precisely. Knowledge is a powerful tool, really, and when you have a good grasp of the tax system, you are far better equipped to navigate it effectively and build a resilient and thriving business. You're in control.
We really encourage you, our listener, to take a moment and identify just one actionable step you can commit to taking this week. Perhaps it's as simple as double-checking that you have your TIN readily accessible, or finally getting those receipts from last month organized, or maybe spending just a few minutes browsing the VAT information on the GRA website. Start small. Building these small, consistent habits of financial discipline and tax awareness is absolutely fundamental to creating a sustainable and prosperous business here in Ghana.
And on that note, here's a final thought for you to consider, something to mull over maybe. Which specific aspect of Ghana's tax system, whether it's obtaining or using your TIN, understanding VAT obligations, or navigating income tax, currently feels the least clear or perhaps the most challenging to you? And what is one concrete action, no matter how small, that you will take this very week to start gaining some clarity on that particular area?